From the morning reading, long tail hammer as institutions turn big red to white. Capitulation bottom, XLV gains, small caps lead. Just one of 9 sectors moved higher on Wednesday. XLV, XLB, and XLK were the strongest sectors, while XLE was again the weakest sector. Oil fell $1.10 from Tuesday's close of 29.43 to close at 28.33. Breadth weakened as decliners led advancers 2.54 to 1 in the New York Stock Exchange and strengthened as decliners led 1.12 to 1 on the NASDAQ. Global sell-off continues. Crude oil nears $25. CRB index drops to the lowest level since the early 1970s, which is deflationary. Treasury ETF breaks out to upside as yield falls below 2%. Dow could drop to 14,000. Weak rebound in the VIX suggests stocks have further to fall. Long-term look at crude. The price of crude oil continues to drop and is bringing global stocks down with it. The 1-month chart shows how bad the decline has been and where it appears headed. The recent decline pushed WTIC light crude oil below its early 2009 low near $33, which represented a major breakdown. Crude has fallen below $27 in today's trading, which puts it at the lowest level since 2003. There's a small shelf of potential support formed near 2003, near $25. Next potential support below that is near $17. The only good news is that the 14-month RSI line is in deeply oversold territory below 30 for the second time in the last year. Falling crude isn't the only problem. The entire commodity complex is collapsing except for gold. The monthly bars in the CRB index of 19 commodities plotted through the day prior to yesterday haven't fallen below its early 2000 lows to levels not seen since the early 1970s. That's a pretty deflationary chart. Problem is, commodity deflation isn't good for stocks. Historically, the only two assets that do better in a deflationary environment are treasury bonds and gold. The VIX has more to go. One of the things we watch for to identify market bottoms is a spike in the volatility index. So far, we haven't seen one. The daily bars show the VIX struggle to get above the 30 level, but recent comparison, the VIX spiked above the 50 intraday during the August market drop before closing just below 40. Just above 40, I should say. That level in the past has signaled some type of market bottom or at least a rally attempt. That suggests the VIX has further to rise before peaking. I think that's probably enough with the morning reading. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:46 a.m. Central Time, and I'm recording this in preparation for the market day of January the 21st, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive into the overnights, and again, another interesting overnight. And we will start with the U.S. future indices, and we'll go to the chart in a moment, but you're going to see that this is probably quite a disappointment for the bulls in that we were way up earlier in the evening and now we're down pretty significantly, though certainly not like yesterday. Currently down about 8 points in the S&P futures, or nearing 0.5%. Russell futures down about 0.2%. NASDAQ down about 0.33%, and the Dow down about 0.5%. Crude oil continues its fall, down about 0.75%. Euro essentially scratched. Bonds up 0.33%, and gold down about 0.5%. In overseas action, it's mixed, with Asia significantly down, China down about 3.25%, Hong Kong down about 1.8%, Japan down about 2.5%. In Europe, a little brighter picture, not huge, but Germany is up about 0.5%, and the United Kingdom is also up about 0.5%. And macroeconomic reports for the US today, we have the weekly variety of the employment claims, and we have Philly Fed manufacturing. That one has not been very bright of late, so that certainly will be one looked at to see what happens on that impact on the economy today. In terms of nat gas traders, you have your inventory report during the market hours as well. Looking ahead for tomorrow, we have flash manufacturing PMI, existing home sales, and that's it of significance for tomorrow. In terms of current volatility, well, we certainly have been getting the volatility, but as you heard in the morning reading, it's been this kind of slow climb, and we've been talking about how while it's certainly elevated, doesn't seem to be the kind of just abject fear that we normally see with significant falls like this. And with yesterday's action, we were down as much as approximately 15% from the highs to yesterday's lows, and certainly starting to have a very serious conversation about bear market territory in the 20% range. So with that, perhaps you might think that the VIX would be even higher. Well, short-term VIX is up over 30 at a 32.85, but it's kind of just crawled up there instead of a big spike. In fact, we've not even had, as one of the authors in the morning reading referred to, the VIX spike, where you have a jump in the VIX from one day to another, which usually is the mark of some sort of capitulation pattern. So there is a question, an open question, and it certainly is a potential that yesterday was a capitulation sell-off, and that could be the bottom for this current leg, but yet at the same time, other signs of capitulation bottoms and flushing and so forth don't seem to be present. IV percentiles are higher, but they're still not high on an annual basis, and an awful lot of that comes from those August corrections where we saw really significant increases in volatility. The S&P is at a 55, the Russell at a 61, the NASDAQ at a 59, and the Dow at a 66. This will seem odd, but from close to close, only the Dow put in a standard deviation move yesterday, and it was about a 1.1, so just barely into that. Obviously, price action was far, far larger than might be implied here. So very interesting. For many traders, though, it's the close to close that's the most important thing, and the closing price is the most important price of the day, because that, at the end of the day, is where bears and bulls agreed on price. And when it was all said and done, there really wasn't that much change in closing price. That being said, we'll go ahead and look at the charts. It was anything but a benign day, and I'd have to say that a significant damage continues, and we've taken out all these supports. We didn't get closes below all those areas, but those were also wicks. And certainly from a closing standpoint, this was the lowest close for quite some period. And then the other part to this is, just what is this action and what does it mean? And we're using the S&P futures because of this significant overnight action that we've seen of late. This wick yesterday, of course, was put in during the cash market, so that makes it very important. It's also important that it turned where it did. In essence, this was probably a front run of 1800, people anticipating a bounce of 1800 and starting to front run that level. So we actually got the turn just north of 1800. And great big long wick. You have to say that, the institutions came in, the bulls took over. There was plenty of volume yesterday that normally we see perhaps even more volume and a big capitulation bottom like we did back here in August. But that being said, it's a very significant wick and turnaround on the intraday basis. Now, what is this? Is this, a wedge pattern with a overthrow, or is this the breakdown of the wedge into more of a channel, which would be very, very bearish? So there's a number of implications here. We'll have to see what kind of confirmation we get out of this. to see, do we indeed get a bounce and reversal? Is this the bottom? Do we go sideways from here? That's one of the potential um, outcomes of this kind of bottom setting behavior, if it is that we could go and bounce, or we could go sideways and do some consolidation and build a base, and then that would lead to something of an increase. We saw something similar to that here. You had the huge, like 92-point reversal here that kind of took you up off the bottom, gave you confirmation, but then it went into this very kind of prolonged and somewhat complex sideways ranging consolidation pattern before finally breaking into a significant leg that took us up to close to the prior highs. But that's not the strongest pattern, and indeed that eventually then went into a new range and then broke down and now setting new lows. So this could be seen as potentially a complex topping pattern in the big scheme of things. And we look back, if we go back further, we can see this is a big rounding top, and then this is just part of the breakdown, and then now rolling over into bearish legs. The question is that what we're seeing, or is this just a continuation of a very, very long sideways pattern? Certainly the broad market has seen in its economy, this kind of slow growth, less than 2% often GDP, yet low inflation, good growth on the employment situation. So it's been relatively stable and relatively positive in the big scheme of things, and yet somewhat not as robust as might be expected given the depths of the Great Recession. So it's very much a transition point here. We continue to have very deep reservations about that the bears could just absolutely dominate and this could break down. And in fact, one of the authors I was reading yesterday that I respect very, very well is predicting another 10 to 12% drop, which would take us into that about 25% potential from top to bottom move. So kind of keep all that in mind. We're watching for potential bounce activity. It certainly is due. We've had something of a parabolic move down. You see I drew a diagonal resistance line here, and we would look for a close outside of that diagonal resistance. And if that comes, that could be one of the first signs of a confirmation towards a bottoming pattern forming. And yet at the same time, this overnight action kind of calls all this into question right now. At one point, I think we were some 20 points up, and then now here we are down here, actually about 25 points below the overnight high. So this is not a pretty picture for the bulls going into the cash market open. Now we're still only like 7 o'clock Central, so we've got another hour and a half before the cash market opens. So we'll have to get through that, and then we'll have to get to the cash market open and see what happens with that. Let's take a look at the other indices yesterday. The Dow, also big breakdown, but didn't quite come back. Again, is this a kind of wedge overthrow? Or is this just the wedge breaking into more of a channel pattern? Very, very steep channel pattern, and you would think again that that kind of parabolic activity would have to come to something of a relief bounce at least. Now the last couple bounces have been quickly met with significant selling, so we may have to be very careful in calling a bottom and being just kind of tiptoeing into positions. NASDAQ also very, very weak, but big tall wick with yesterday's bottom tail. And then the Russell actually put in a positive day yesterday. Pretty amazing given just how far down it went. And then let's take a look at volatility. So unlike this action here, and one of the morning authors from our reading was talking about how we had this huge pattern that exploded, and you had VIX spikes, and you popped up over the 30, and this is using VIX futures. Here, this was much more of a gradual kind of climb up into these levels, and not really so much of a big spike. Obviously, there have been some big down days in the market and some big increases in volatility, but not quite to the same kind of proportions as what we had with the August correction. So while this correction's actually dropped further, volatility is, significantly lower still than what we got with the August correction. So doesn't quite feel like capitulation quite yet, but sometimes these things aren't picture perfect and textbook, and we'll see where the next few days take us. We are very overdue for a relief bounce and probably a pretty significant rally given the amount of fall that we have had. And then last, let's look at the bonds. Bond certainly isn't signaling yet a capitulation, though it is up against, some pretty significant resistance. And indeed, we have a partial cover call in this area using TLT, thinking that this could be a top for the bonds and then a pullback at the very least. At the same time, I said partial because if the market does truly break down and start heading towards those 1750 to 1730 areas, we could see this bond market break through that resistance and continue. So we don't want to have everything capped off there. Let's look at the SPX and see what I'm talking about there. And we'll go to weeklies. We'll get a longer perspective. And if we do get a breakdown into this area, at this point, I would say that this wick bottom here and the wick bottom from yesterday and that 1800 round number is likely to serve as an immediate level of support. But if we break through that, then we probably come down here into this 1740 to 1750 area as our next target. So just kind of keep that in your back of your mind. That would represent about a 20% drop from the 2134 high back around Memorial Day to that 1750-ish area. That would put us in bear market territory. And that could also serve as a bit of a support area. So that's probably the target for the next leg down if we should now break this important area around 1800. 1800 is kind of our key metric for the moment. So enough on the charts. Let's get over to our daily opinion. From this one, I will move this pretty quick today. Not a lot of changes. We're still phased by the break of diagonal horizontal support. We're still very ugly in all aspects: IBD status, market and correction, accumulation, distribution for both the S&P and the NASDAQ and E. GMI index a 0 out of 6. Sell signal has been in place since 1210. That author remains 100% in cash. Saw another author that I follow yesterday also mentioning that they're 100% in cash. So it's very interesting when you see these technical chartist gurus that are sitting in all cash and are not thinking that the bottom is in and starting to accumulate positions. They're waiting for more of a confirmation of that pattern. Decision point scoreboard also remains the same, very ugly. Obviously, the consensus of these mechanical signal opinions is that we are in a very ugly place in the market, outright bearish, and we're looking for the potential to perhaps slide into even a bear market. Intermediate term posture is severely bearish with a very bearish sentiment line. Position sizing opinions remain decidedly defensive with 0% and less than 50%, and this one could go to 0 if the VIX closes above a 30. You see the indexes here, really poor numbers. Hedge warning status remains level 3, which is a crash warning. Doesn't predict a crash warning, but it says the potential is very elevated and the potential is there. And then in terms of our individual metrics, again, I won't go through all this. There's very little change from yesterday. We do have a volatility ratio warning that has had a first day close inside. So that could be a sign for a market reversal. We'll continue to watch for that. New York Stock Exchange, new highs, new lows. I can't remember ever seeing a number this low. Perhaps back during August it was, but I don't remember a 1636 for new lows. So very, very, very bearish activity there. Key intermarket risk aversion indicators, all 5 are risk off. Fear and greed index, a 9, which is in the extreme fear area. Now, when we get sentiment this low, that sets you up for the potential rip your face off bullish reversal. And you saw something of that during the intraday yesterday between the lows and the close, or for that matter, the lows and the rebound high was something like 60 points or so. So that is a rip the face off the bears on the intraday basis. And yet at the same time, it's quickly been trumped with last night's activity. Special opinions, not acceptable to initiate new positions for novice traders, and frankly, aggressive traders and experienced traders would probably be best served to be sitting on cash and developing watch lists, working on your strategies, than to be entering a lot of new bullish positions. Now, as for bearish positions, and we closed a bearish swing trade yesterday right at the bottom. We were really pleased with the timing on that. But anyhow, bottom line is that you could certainly be putting on some bearish trades as the opportunities present in this market. Just have to be really nimble taking those targets out, just like we did yesterday. We took those targets out, and we're happy to take that profit and not sit through a bullish reversal. Indeed, instead, what we look for is to re-enter and initiate new bearish positions. In terms of sector-specific market posture, a sea of red here, really not much to look for in terms of bullishness. And on the percent change, you see also a sea of red here. And the sea of red continues through multiple time frames. So not the time to be getting too excited about rolling out those bullish strategies as of yet. That's a lot. So we had a big day yesterday. We've gone a little longer than we'd like to go. So we're just going to go right to the disclaimers here. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. And then, of course, the hyperlink will take you to the full disclaimers. And we'll see you back here tomorrow morning for the Falcon Global Market Preview. Good trading.